Well, hello there, ladies and gents. Great to see you again, and welcome back to Modern Wealth Management. Ryan Ruff here, your moderator. But as always, I'm joined by my right-hand man, Darrick Hutchins from Monon Wealth. And of course, we're going to be jumping into another wealth management-related discussion, as we typically do on the show. We've got a great guest lined up for today's discussion. Really excited. We've had this date circled on the calendar for a little bit. Looking forward to be welcoming Mr. Apollo Lupescu today to the show. And of course, Apollo is the vice president over at Dimensional Fund Advisors. But we're going to be talking through a unique topic here today, kind of the evolution of investing, if you will, and kind of some of the state of the art strategies that exist out there. But before we get into the nitty gritty of everything today, let's go ahead and say hey to Darrick. Darrick, good to see you today. How you doing?
Hey, I'm doing great, Ryan. And you're right. We have been anticipating this for quite some time. I've heard a lot about Apollo, and I'm looking forward to having a conversation with him here this afternoon.
Very cool. Very cool. Well, hey, with that, Apollo, let's go ahead and welcome you to the show. Thanks so much for carving some time out of your day to be with us here on Modern Wealth Management.
Hey guys, great to see you, and it's something that I've had on my calendar myself because I'm very excited about this topic, and I love the idea of a conversation about this evolution of investing, how have things changed, because it's really relevant to everybody out there. Everybody who is investing in the market needs to get a sense of how things are different today from maybe when they have started maybe 10, 20, 30 years ago.
Apollo, again, welcome to the show. Thanks so much for carving out some time here for us. Like I said, I've been excited about talking with you and hearing about yourself. Tell me, let's start off by telling me a little bit about you and your role within Dimensional Fund Advisors. A lot of people in our audience may not be familiar with Dimensional Fund Advisors, so I'll let you kind of take the floor and kind of set the stage as to who you are and why you're the right guy to talk with us here today.
Why am I here today? Well, let's start with Dimensional because I think you're absolutely right. Most investors, non-professional investors, they're retail folks, what we call the families of the world, they're not really familiar with Dimensional as an investment fund, even though we are, one of the largest investment funds in the world, and we are regulated and run like any other firm out there, like investment management firm, like a Vanguard or Fidelity, you name it. So Dimensional has been around for over 40 years. So it's a well-established, mature company. We manage over $700 billion in assets. And what's interesting is that the clients for whom we invest these assets are either large institutions like pension funds, endowments, and so forth, or clients of certain financial advisors. And we'll come back to this in a second. In other words, we don't work directly with the investment public, with the retail investor. Our bread and butter has been the institutional side, whether consultants, institutions, or financial advisors. And because of that, we have never advertised. You would not have seen like an advertisement in Good Housekeeping magazine or a billboard or anywhere because the mutual funds are not even available without a financial advisor or a consultant. So I think the first thing that really sets us apart is that for the past 40 years, we have been pretty much strictly an institutional money manager. And now within the advisor community, I think with the financial advisor community in the US, we are the most recognized and respected name. The second thing that sets Dimensional apart is that from day one, we really wanted to have a very rigorous scientific approach to investing. And from day one, we have tapped into this academic community. And what's fascinating is that over the past 40 years, we have worked closely with 5 different Nobel Prize winners in economics. And we worked with them before they even got the Nobel. Not that they got the Nobel, they just paid them a bunch of money so we can attach their name. That's not the case. So it has been this incredible cross-fertilization between the scientific, rigorous approach to investing and the practical side of how do you implement those strategies. And even today, our board of directors, our investment committee, it's pretty much driven by academic research that has practical implications for investors. And the third element that sets us apart is that when you look at the traditional ways in which money is invested by a fund company, on one hand, you have what's called stock picking, which is let's find the diamond in the rough. Let's find the one thing that nobody else has found and pick some stocks. That's called stock picking. We're trying to forecast where the markets are going. And that's the conventional type of Wall Street approach. And on the other hand, you have what's called indexing. And indexing simply means that you're going to license a list of stocks provided by a committee, the S&P committee, Dow Jones, Russell, MSCI. There are a bunch of these providers. And then I'm going to create a mutual fund that perfectly replicates that list at all times. And I'm going to call that an index fund. And that's for the most part what BlackRock and Vanguard, these index shops, have done. And you know, it's been very successful because it is more diversified. It tends to be lower cost, more transparent, and investors have liked that over the past few decades. And what's fascinating is that Dimensional's strategy is neither conventional stock picking nor indexing. It's basically it's the fertile middle ground where we're trying to outperform, but not by picking stocks. So it's a very unique company, both in the way that we do business, with whom we do business, the academic affiliation, but also very distinct strategies for investors.
Well, I appreciate that you said that. And you're right in that while, a lot of the audience here today is more likely than not a retail investor of some kind or another that's investing money for their retirement or for their children's education or just for their general well-being. Um, if I were to mention Dimensional Fund Advisors to them, they would not recognize that name. But if I mentioned Vanguard or BlackRock, those others that you said, well, or Fidelity, um, well, these are really front and center, right? They people know these names. But like I said, and for the last 24 years, I've been on this side of the desk, helping my clients make decisions, reading the research journals, and it was actually the research that you guys are consistently doing that attracted me to your company. Over 24 years, I've heard everything known under the sun, right? I mean, I've been on the constant search for that guy that knew that Nvidia was the stock that was going to get hot over the last 18 months. And for 24 years, I've yet to find him. Still looking. Full disclosure here, still looking, but I haven't found him yet. So it did attract me to Dimensional and the way that you guys approach the markets. And while all that sounds good, can you kind of put into context? I mean, you guys are not new. You've been around this business, I believe, since the mid '80s. You've been doing this kind of work. How do you guys stack up against the Vanguards, the Fidelities, the BlackRocks, the S&P 500 that people say you can't beat? How have you guys done as a performance compared to this?
Yeah. So to answer that question judiciously, let me start by kind of defining when you hear of Vanguard, Fidelity, S&P 500, and then kind of be able to do a comparison in terms of the funds. I think it's really important to start with conceptually how are we similar and how are we different than some of these funds that you mentioned. And I'm going to start with just the evolution. We talked about the evolution, and that's such an important concept that historically, and I'm going to start with a little trivia, by the way, Derek. Any guesses what might have been the very first stock that traded on modern basis in the world? When did this idea of stocks come along in the modern way that we have today? Any guesses?
I've never been asked this question. I have no idea, but I can't wait to find out.
Well, my kid asked me that a few years ago, and I ended up digging it up. The very first modern stock trading exactly like today was the Dutch East India Company back in 1602, over 400 years ago, and it happened to be in Amsterdam in the Netherlands. And at the time, there were these merchants who tried to build enough ships that if any one of them went down, then they wouldn't just be going under. So what they decided is like, well, the only way to do it is to create some scale by opening up the ownership to other investors who would give us the money today, and we would build those ships, and then they would partake in the profits that the Dutch East India Company would make, which makes a lot of sense. But they did it the right way. They opened up the ownership to the public at large. And then they said, okay, so if you have a share of ownership, you can partake in these earnings. But if you don't want to wait for the earnings to come in for years and years, you can give it to somebody else, and you guys decided what price you want to trade. And that was the birth of the stock market. The very first stock market was in Amsterdam to trade only that one stock, the Dutch East India Company. And soon enough, investors realized is that the number one key ingredient to be a successful investor, if you want to buy and sell, is information. If you knew what ships went under, which ones are going to come back, well, that gave you an edge because you're competing with somebody else. For every buyer, there's a seller. So what these folks would do is go to the harbor probably, and then find out how many pirates might have taken ships over, or how the weather and all this stuff. And it turns out that back in those days, you can imagine that it took weeks for information to get to investors.
Yeah.
Well, over time, the biggest change, in my opinion, that's happened is the speed to which information travels. That it went from weeks to days to hours to minutes. I would say that maybe 40 years ago was in the seconds. Today, it's almost instant. But what it did, this idea of information, it created a pretty interesting dynamic, because if you got better information, you got it faster, or you can process it in a superior way, well, that gave you a competitive edge. And about 100 years ago, a gentleman named Benjamin Graham started to highlight these considerations in a more formal way, in a more rigorous way. And in fact, he was Warren Buffett's mentor. And what he suggested is that if you analyze the data for individual companies, if you look at unemotionally at the numbers, then you ought to be able to select a number of stocks that might do phenomenally well. And he introduced this idea of stock picking, where you analyze companies and you cherry pick a handful of the stocks that you think are going to do really, really well, and then you just leave out everything else. That's the birth of stock picking in a more modern way. And that's what traditional active management does. They just basically analyze companies, they look at them, and they just say, well, I'm going to choose that versus this. And I guess there's some merit to that, because if you look at Warren Buffett, he certainly did very well by doing that. Now, the thing that's changed is the speed of information to investors, the availability of information. So if you need to compare and say, how do these managers do today, and just evaluate them as the world changed, I would say that things are very different today than they used to be. Because information now, it's almost instantaneously coming to investors. The availability of information is overwhelming, and it's gotten to be incredibly competitive. There are more investment managers than actual stocks trading in the market. It's incredibly competitive. So what's the result of that? The result of that is that if you look, for example, at 10 years, and you look at all these funds, about a third of them don't even survive. They basically shut down. And out of the ones that survive, only about a 27% outperform, meaning that 73% of the funds over 10 years tend to underperform. And so you have a lot bigger chance of finding an underperforming fund than a winning fund. And if you give them more time, if you give them 15 years, only half survive. And out of those, only 1 in 5 actually outperform. And if you give them even a longer time, instead of getting better, it gets worse. Fewer survivors, and only 1 in 6 roughly outperforming. 5 in 6 underperform. So this system of investing that is based on stock picking and analyzing individual companies, in my opinion, it's something that might have made sense, but it's a little bit like Blockbuster Video that made sense in the 80s and 90s. But Blockbuster Video in the age of Netflix and Disney Plus doesn't make as much sense. So the alternative to this came from the academic community. And this is what Dimensional pioneered, which is a different type of research. And the idea here is that instead of looking at individual stocks, you absolutely want to consider these stocks. Yeah, there's no reason why we don't want to look at them. But instead of trying to form an expectation or to try to predict individual company performance, what you want to do is consider those stocks as part of a larger basket of stocks. a larger group of stocks. And this is what's become known over the years as asset class investing. This is what computers and data have allowed us to do, is not analyze individual companies, but analyze much larger baskets of stocks in a way that just wasn't possible before computers. And a lot of individual investors, they don't have the resources, whether it's the data or the computers, to be able to do this. So this is something that academics and institutions like Dimensional, with $700 billion, they can do. But it's an incredibly powerful way to look at the world. And this occurred to me when, I was swimming a few years ago in the ocean. I still like swimming. And I looked down and there was a school of fish swimming with me. And he wasn't the Finding Nemo super colorful, but it was fun to look at them. And what you see is that every fish was moving so randomly, up, down, left, right, sideways. No one can predict how each individual fish would move. But once you swim a little bit longer, you start to capture and understand the behavior of the entire school of fish with a lot more precision. And that's when it hit me. This is like what we're trying to do. We're not trying to predict how each fish should move. We try to look at the entire school of fish. We're not fishing by the rod, we're fishing by the net. And I think that's the big distinction. That's the evolution where most companies, more large, most investors at the sophisticated consultant and institution level have moved in that direction to really try to understand the school of fish rather than try to individual fish. And at that point, again, what dimensionalists try to do along with these academics is ask a fundamental question. Great, it's competitive, the price is pretty fair, you can't really tell they can pick one stock or another, but does it mean that you have the same growth opportunity for every single stock in the market? Is it all the same? And obviously, no, there's got to be some differences between these stocks. And quite often you hear about pharmaceuticals versus transportation, which has to do with the sector, or technology stocks versus you name it, energy stocks. And it turns out that is a consideration, but not a primary one. And rather than those, what academic science and dimensionalists found is that there are other distinguishing factors among stocks that carry a much greater weight. So what are those distinguishing factors? The first one came in the late 70s, early 80s, and it was the realization that in the U.S. market, and again, let's consider the square to be the entire stock market, you have these very large companies that make up the S&P 500 or the Dow Jones Industrial Average. And at the same time, there's another group of stocks that is also part of the market, but they're not part of the S&P. And those are what's called small caps, or the smaller companies. And these companies both have a little bit more room to grow. So think of small caps as Shake Shack and large caps as McDonald's. They're both burger joints. But when you think of the growth potential, I would say that most folks would say, Shake Shack is perhaps easier to grow and double in size than McDonald's. On the other hand, McDonald's is more mature. It has a longer track record. So it has perhaps a little less uncertainty than Shake Shack. So this idea of both the growth potential and also the uncertainty would lead investors to have different opportunity sets. And that's what the data shows. We have a book that's called the Matrix book. And it's a fascinating book. It's one of my favorite books in investing, and it's something that we have used for a very long time, and it's full of data. And if you look at the 2023 version, that's the last one the new one just came out. But if you look at this, there are some really important insights into how to consider these different asset classes and how relevant these distinctions are. If you look at that and you look at the S&P 500 index and you look at the growth over the long run since the 1920s, $1 invested in the S&P 500 would have grown to over $11,000. If you had put the same dollar to work over the same time frame in the smaller company, and you look at the small cap, the dimensional small cap index over the same time frame, that growth would have been over $41,000. So significantly greater growth in small versus large. So that's first distinguishing factor that came along about 40 years ago, and that's where dimensional started. If you want to do better than the S&P, one thing that you can do is not pick stocks, but really be more purposeful in the way that you add small caps to your portfolio. And in the 1980s and early 90s, the question was, are all the large and the small the same? And it turns out there's another distinguishing factor that even Warren Buffett talked about and Benjamin Graham, which is at which price do you buy a company? And the lower price companies, for some level of accounting fundamental, like book value, the lower cost stocks called value, they tend to outperform the more expensive counterparts called growth. So if you knew that both small beats large and value outperforms growth over the long run, then what you see is that that one group of stocks that is both small and value ought to give investors the biggest bang for the buck. And in fact, what you see is that the same dollar over the same time frame invested in small value would have grown through this dimensional small cap index, small cap value index in the book, in the Matrix book, to over $128,000. So once again, significantly more. And that has given investors this primer, this way of thinking about investing, which is not about picking stocks, but be purposeful in the way that you emphasize different groups of stocks. And the more you lean towards value, the more you emphasize small, you give yourself a chance to earn a higher return down the road, high expected return down the road. So it's been a long-winded answer, but I wanted to kind of give a sense that how can you actually beat the S&P without picking stocks? One of the ways to do it is by being purposeful in the way that you emphasize different parts of the market. You reshuffle the deck, and when you reshuffle the deck, you can tilt what's called tilting portfolios towards these dimensions of higher returns, expected returns, and that's what we're trying to do. And again, to really finish it off, the reason that most people don't do this without an advisor, and he has to be a very qualified advisor, so you have to understand the data, but it's also so much about the human element that people expect to see this every day, and if they don't see it, they will be disappointed. And when you look at the data, these numbers are, accurate, and yet on a year basis, if you look on a single year, for example, 60% of the time you would see that value beats growth, which means that 4 in 10 years, you're not going to see that value beats growth. And you will be disappointed. And you might say, I'm out of here because, look, it's been a year. I'm not seeing this. I'm out of here. And yet, even with 1 year, you have better odds to see value beating growth. And if you give the system time, even after 5 years, you improve your odds. It's just not 100% of the time. 1 in 3 periods is not there. Even 10 years, you once again improve the odds, but it's not every single time. So this whole system, in my view, requires an advisor that understands that investing is not about certainty and guarantees, but much more about how to tilt the odds in your favor, how to put the odds in your favor. And probably the number one way to do it is to make sure that you are strategic and you are disciplined in that process.
I love that. And obviously, I was familiar with that story from Dimensional, as I am a proponent of the solutions. Let me ask you, though, I mean, you just said right there, it's easy to be disappointed, right? We're here on a podcast or, a video talking about state-of-the-art strategies. That's actually the name of this episode. And when I think of state-of-the-art, I'm thinking about all the exciting technology that exists in the market right now. So if I were to say, hey, I'm going to do an investment conference for my clients, it's going to be state-of-the-art strategies. They will be expecting for me to talk about AI, cryptocurrency, different technologies, maybe some new bio funds that are coming out. But that's not what we're talking about here today, is it?
No, I mean, it's not. It doesn't mean that those companies will not be included. Not at all. It just means that you want to be a little bit more conscious of the fact that those are not the only companies that you want to own, number one. And number two, you also want to be careful on when exactly do you own those companies. Because by the time they become part of these conferences, everybody hears about them and all, it might be a little bit too late. And let me give you like an example from this year. one of the best performing stocks, if not the best performing stock this year in the U.S. market, is not NVIDIA. It's another tech company that kind of works with NVIDIA's to create data centers for these AI systems. And it has a great name. I actually love the name. It sounds like the 80s and sounds like Austin Powers, but I love the name. It's called Super Microcomputer Inc. SMCI, and it's a phenomenal company. And what's interesting is that it got to be on the radar to the point where on March 18th, this is March 18th of this year, as this company was going so well, was doing so well, it got added on March 18th to the S&P 500 index, which is the group of stocks that tends to be representative of the U.S. market, and is the largest 500 companies in the market. And when it got added, the price at which it got added was about $1,000. And that's when it came on everybody's radar. It's like, look, super microcomputer, and the reason it got to be in the S&P and be so renowned because between January 1st of 2024 and March 18th, it had a phenomenal growth. On January 1st, the price per share, this wiggle signs means approximately $285 per share at the beginning of the year, and within 6 weeks, it went up. It shot up to about $1,000, more than triple in a few short weeks. Now, again, you see it now part of the S&P. It's the best performing stock in the market. The thing is that if you look at June 30th, the same stock on June 30th was not worth $1,000 anymore, but rather it was worth about 820. So what it means is that this particular great stock actually was a detractor of performance from the S&P, because by the time it got added to that metric and it became visible to everyone, it already started losing value. And the reason I bring this up is that successful investors are not necessarily buying Amazon, but they're looking for the next Amazon. They're not buying NVIDIA, but looking for the next NVIDIA. And you cannot have the next NVIDIA if all you do is hold NVIDIA. You have to go and try to find it in a different part of the market. And typically that is the smaller and mid-cap stocks. So if you had a broadly diversified market portfolio, you would have had this SMCI stock even before it got added to the S&P, and that would have been the time to get it, not after it got added to the S&P, and by then it's already started to go down.
Well, that makes a lot. That makes a lot of sense to me. You're right. If we were to ask a group of clients what stocks have performed well or what stocks do they want to be in, those two lists of stocks may look identical, because a lot of times what we do is we look in the rear view mirror and say, oh, well, I wish I was in those, so I'm going to put them in my portfolio now. There's certainly no guarantee that they will continue the run that they have been on. As a matter of fact, I think it's probably more likely that they don't continue that run. Would you agree?
Absolutely. They get very expensive. And we actually looked at this, and the larger, world dominant companies, sometimes they might continue to be large and dominant, but for the most part, what you see is that once they reach that level, it's hard to sustain the returns that they had. Because like they're so big, it's harder to them to find markets. You got more government scrutiny, so there are a lot of problems. But you also brought up something really interesting. Like, you never know which company is going to do well and which company is not going to do well. So if you look at the S&P for the first 6 months of this year, roughly speaking, these are some rough numbers. About 40% of the companies in the S&P lost money, even though the S&P as a whole is up about 15% for the year, and about 60% made money. And obviously the trick is knowing which one is going to make and which one is going to lose money. And the trouble is that if I gave you two companies, let me just toss an example. Two close cousins, FedEx and UPS. They both ship boxes. Well, I'm kind of agnostic which one I use. Do you think that both of them went up or went down?
You would think they'd move together.
They move together. Well, it turns out that the UPS is down more than 10%. FedEx is up more than 10%. You look at Nike, the shoemaker, and Hoka or Uggs, different types of shoe business. Nike's down about 30%, and the maker of Hoka, Decker Outdoors, they're up more than 40%. McDonald's is down more than 10%. Chipotle is up over 20%. So it doesn't have to be that it's that obvious that which company is going to do well, which one's going to go in the left bucket and the right bucket, and you need to diversify. And nobody could have said, oh yeah, I know UPS is going to go down this year. No, and FedEx is going to go up, because most often you think they're both going to move in lockstep. They don't have to.
In staying with the U.S. market conversation, I mean, we clearly have been in a pattern here where the bigger just keep getting bigger. Okay. And I think everybody's talking about the concentration of those companies and how much how big they are. And therefore, if I were to invest in an S&P 500 fund, I'd have a lot of those, right? That Mag 7, we used to call them FANG, they switch names every now and then, right? But, they're bigger than ever. And they continue to gather this momentum. As we sit here today, it's July of 2024. These big tech companies have been on a run now that seems like 10 years plus. Why wouldn't somebody just jump on that bandwagon? I mean, 10 years is a lot of evidence in in most people's lives. It's quite frankly, it's about 23% of my life. So why wouldn't you just jump on board with that?
Yeah, and I think you're absolutely right. It has been about 10 years or so, and when you look at these companies, they basically they have been powering the U.S. stock market quite significantly over the past 10 years, to the point where it outperformed globally, like all the other stocks. And I'm going to give you one one little story that kind of got me thinking. In December last year, I had the privilege of traveling to Tokyo and meet with Japanese investors. And it was interesting because a lot of them were reluctant to invest. And these are, older couples. And I try to understand why the reluctance to invest to begin with. And I try to understand what's the background of this. And when you look today at the world, there are all these different companies that you can invest in. And these U.S. companies that he mentioned, the McDonald's, the tech companies, the NVIDIA, Apple, Microsoft, they amount today at about a quarter of the value of all stocks in the U.S. So about a quarter of all stocks in the U.S. come from these 7 companies. But what's interesting is that all the stocks in the U.S. combined, so about 59% of the value of all stocks in the world come from the U.S., and Japan is the next largest country at about 6%. So the reason I bring this up is because in Japan, again, there's this reluctance to invest, even though they have 2,500 different companies. And what I gathered, which is really interesting, is that these investors, these Japanese families, started to invest in the 1980s, in the early 80s. And when they started investing, the Japanese economy was the envy of the world.
Yes, it was.
There was the envy of the world. Like, they did everything right. And I don't know about you, Darrick, but my dad gave me a Learn to Speak Japanese book because they said, son, that's the language of the future. You might as well learn it. And that was kind of what everybody thought, that the Japan will take over the world. And one of the reasons for that is because they had these unstoppable technology companies. And Darrick, you might be too young, but in the 80s, what everybody wanted and what I wanted was a Walkman. Yep. And a Sony color TV and a VHS and a Betamax, and all of those products that everybody wanted to buy were made by these great Japanese technology companies. And throughout that decade of the 80s, what's incredible is that the Japanese market was on a tear, more so than the technology boom of the 90s. 1 yen invested in 1980 by the late 80s would have actually increased 7-fold. An incredible growth in the Japanese market, to the point where it's so interesting that in 1990, the Japanese stock market was actually bigger than the U.S. market.
Wow.
That was in 1990. And after that, it took the market about 30 years to recover from those losses. But put yourself in the shoes of that Japanese investor in 1990. We have an economy that is the envy of the world. We have technology stocks that are unstoppable. We have incredible performance over the past decade, and we are the largest stock market in the world. Where are we hearing this today? That's exactly what I'm hearing from U.S. investors. And by no means am I suggesting that's the path of the U.S. market or the U.S. economy. Not at all. What I'm suggesting is that things change. And something that seems so obvious, which seems so obvious to those Japanese investors, exactly the same premise. And they said, I don't need to diversify. Let me toss everything in the Japanese market. How did that work out for them? So all I'm suggesting is that it's still very wise to diversify and not plow everything into something that seems unstoppable right now, because things change, folks. And it might not be in terms of the country, it might be in terms of the companies. Intel and Cisco seemed unstoppable, and now they're shadows of former selves. So I absolutely am 100% a believer that you should own these companies. I am not a believer that you ought to overly concentrate in any of them.
I love that. I love that. I've used some of those same analogies myself. Let's switch here a little bit, and something I think as we talk about 10 plus year long trends. I was taught growing up in this industry that we needed to diversify our assets across different geographical boundaries, and when the early 2000s, so I'm talking 2001, 2000, probably 2001 through 2007. You think about what was hot then. It was international and specifically emerging market stocks over that time frame. And quite frankly, since the great financial crisis, international stocks have been somewhat dead money. I'm now hearing, so we're now, several years into this. Darrick, you don't need international exposure because our S&P 500 companies, they sell across geographical boundaries. So you're automatically getting exposure to these other economies. Does that hold water?
Well, it's an interesting argument. I've heard it myself, and we looked at this, and I have to say that it is interesting that people make that connection that we are selling abroad, and that's diversified enough. I have an intuitive thing that kind of hit me actually by a year or two ago, as I was walking down Westwood Boulevard in Los Angeles. And I just, I went to get some groceries, and I was walking the store, and the thing that hit me is like, how fortunate are we to have the variety of cars that are available to us for purchase? And to me, what it triggered is this idea that investing in the U.S. is basically saying that I want to own a piece of these great American companies like Ford, GM, Tesla. And we certainly see a lot of these cars on the street, and it makes absolute sense. I want to take part in these great American companies. Now, on the streets, not just in LA, but around the country, you don't only see Ford and GMs. You also see some Beamers, some Mercedes, some BMWs, some Porsches, and those brands are owned by German companies that trade in Germany. Even Jeep and Chrysler, great American brands, they're owned by an Italian company, Stellantis, that trades in Milan. That is international investing. We're familiar with, the Hondas, the Toyotas, the Japanese car companies, and even brands like Land Rover and Jaguar. Those are owned by an Indian company, which is emerging markets. Volvo is owned by Geely in China, and that's emerging markets. The largest maker of electric vehicles is not Tesla, it's BYD. That's an emerging market. You also have Korean shops that are certainly making inroads in the UAE, Hyundai and Kia. So ultimately, the intuition here is this. If it's worth having Ford and GM in your portfolio, why not consider BMW, Toyota, and Jeep for that matter? Because that is international investing. why say I only own Ford and GM? I don't really care about Jeep, Honda, Mercedes, BMW, Volvo, all these companies. So to me, there is an intuitive reason to say, yeah, absolutely. This is not just about what we sell to foreigners, but what is being sold to us as the largest economies by these foreign stocks. So that's the first one. It's more the intuitive reasons. But if you look at the data, you're absolutely right. If you look at the past decade, actually 2010 to 2020, the U.S. is not the top, but the second largest, not the second largest, but the second best performing stock market in the world behind New Zealand. And that's when you had these questions. Now, the thing is, how consistent is this outperformance? And what's fascinating is that if you look a single decade before, one single decade before, the U.S. is nowhere near as the top, but it's towards the very, very bottom. And then I remember nobody the decade before was disappointed by the international diversification. They were like so happy that we had it. And even if you look over decades, yes, if you roll all the countries together in this developed index, the MSCI World ex USA, you see that over the past 10 years, the U.S. powered by these technology stocks, the S&P outperformed international. But we have data to the 70s. And in the 1970s, international significantly outperformed the U.S. The 1980s, we talked about that. Once again, significant outperformance by international stocks. And then the technology stocks powered the 90s, and the S&P outperformed. But we know is followed by the lost decade, the negative performance over an entire decade in the S&P. So when you look at data, you kind of say, great, we had these technology stocks in the 90s, we had the technology stocks today that have powered the U.S. to outperform. But 3 out of the 5 decades, international stocks outperformed the U.S. And I'm glad to have the U.S. I'm glad to have international because it's not consistent at all to say that, oh, U.S. always outperforms. So because of that, I am still very much a believer in having a balanced, diversified portfolio. And it doesn't mean that you should put all the money in the U.S. or all the money abroad. Yeah. It just means that you have to have a balance, and that's based on a plan. And I know, Derek, that's a lot of what you do is really blend the portfolio that is commensurate to the economic value of these companies.
Yeah, I certainly do, and I'm loving this conversation. I remember specifically having a conversation in 2006 with not a client, but he was a neighbor, and telling him a little bit about my investment philosophy and what I do and so forth. And I'll never forget, it was late 2006, and he told me, he said, I don't know why you allocate any money to U.S. stocks. Don't you know that the best days are behind us? And here we are in 2024, and I'm getting, why do we own anything other than U.S. stocks? Why? Okay, so these things do, and I've seen them flip flop, I've seen them switch, and I'm just loving this conversation. Hey, listen, I got to ask you something, and this is something that's been on my mind. You started off by telling us a little bit about Dimensional. You told us about the research, the Nobel Prize winners that have been affiliated with your organization. I know, you're talking about Fama, French, and, being the two of the most famous there. And I know that they are, they're famous for being able to go back in time and track how different stocks, different asset classes, different things performed. And when they go back in time, some of the studies I've seen, they're looking at the 1950s, 1960s, 1970s, and into the 80s. My question to you is this: is the data from those days that were before I was even born, are those relevant today? And I say that because there's very little in today's economy that is anywhere close to the 1950s. Very little. So how can looking at data from a time that doesn't feel like it resembles today, How can that help us guide our investment direction moving forward?
Oh, absolutely, and that's so true because you feel like, boy, things that happened, they have, like that's a lifetime ago. How can you possibly bring that? So what we're looking for is there are certain things that certainly change in the world, and there are certain things that sort of stay the same. So there's got to be a fundamental premise that we believe stays the same even as things change in the world. And I have to say that I thought about it because one of the questions is like, is it different this time? And of course, it's different this time. But does it mean that it's because it's different, the old rules don't apply, that everything's off? So the thought that I had is that when you play a game of chess, and I started playing chess in the pandemic, you never end up in exactly the same position. It's always different, but there's a fundamental premise that stays the same. You have a chessboard with 64 squares, 16 pieces on each side. So the question is, even as throughout time things have changed, they might not look the same. What is that fundamental premise, the chessboard of investing, that still makes that data relevant? And to me, there are two things. One is that the fact that we operate in free markets, and in free markets, companies will find a way to make money, and investors will look to deploy capital based on the expectation that those companies will make money. I think that's exactly the case. And if anything, investing has improved because of the quality and the availability of information. The second thing that I believe will continue to make this is that fundamental premise that when you are investing your money, you have to receive something that is commensurate with the risk that you're taking. And that premise has not changed. And if that changes, then a lot more things have to change in the world. But I don't believe that changed. I think that when you look at companies that are smaller, yeah, you have a greater growth potential, but they're also riskier. So you have to compensate investors. So those two things, I believe, that are the premise that will continue to drive the markets forward and make the data relevant from the past, because those exact premises were also present with us 100 years ago.
What one last question. Part of that in looking backwards, you guys use a lot of data regarding price to book. In today's technology economy, is price to book still a valuable tool to measure value?
Oh, absolutely. And we've looked at exactly that issue. And in fact, we have a whole research specifically dedicated to that. And what we found is that the price to book does as good of a job as using a variety of the other metrics that you could use. So we have looked at other metrics. When you look to implement in portfolios, none of the other metrics actually do a better job than the price to book, even as today more of the software and everything drives the book value. So absolutely, it is still a valid one. We've looked at this, and it's still the best way to implement. And nothing has fundamentally changed in terms of, even as the technology and the software has changed. So we still absolutely think that book value is the way to do it. We've looked at this, and for folks interested, there's certainly a lot of research that we can point them to.
Apollo, I appreciate your time today. You've been an excellent, excellent advisor here to us, giving us lots of things to think about. And I want to thank you for your time.
It's been a great pleasure talking to you.
All right, fantastic, fellas. Really appreciate Apollo Lupescu taking some time out of his busy schedule to join us from Dimensional Fund Advisors. A lot of great insight there left for us. And folks, if you enjoyed today's discussion, you learned a thing or two, I know I did, make sure you hit that subscribe button on whichever platform you checked us out on today so that you don't miss out on any of these great conversations where Darrick and I will either chat through some of these great investment strategies or really wealth management practices as a whole, or bringing on some great guests to dive into their world, their expertise, so on and so forth. At the end of the day, we want to make sure we're bringing value to you here on this show. And by subscribing, you won't miss out on any of that good stuff still to come. Before Darrick and Apollo, I'm Ryan. We're going to go ahead and say so long now, but we appreciate you stopping by and being with us on Modern Wealth Management.